you very much for joining us, everyone.
Hi, thank you, everyone. Can you see my screen? So thank you for having me. Thank you for everyone who took the time to make it happen. So this is my job market paper entitled Fixed Income ETF, Bond Liquidity and Stress Market. So the motivation on this one is fairly easy. We know that it's, I think, the fourth paper on this webinar series on ETF. We know that ETF are stock that track indices, and we know that it's a growing industry. You can see in that chart that the assets under management for ETF has risen from just above 1 trillion in 2009 to 6 trillion at the end of last year. And the second remarkable feature of this chart is the growth of fixed income ETF that you see in green. And what's interesting is that that growth came very late in the last decade, and just recently reached the trillion of assets under management. What's interesting about fixed income ETF is the liquidity mismatch that's been discussed here before. That on the one side, you have a liquid corporate bond ETF that trades on the stock market with a very tight beta spread and large trading volume. If you think of LQD, the main investment grade ETF, it trades over $2 billion per day. But on the other end, if you look at the corporate bonds, we know that trade over the counter on dealer market using voice, mainly Bloomberg chats. And Maureen O'Hara has shown us that the electronic RFQ is growing, but is still very marginal. I think the 14% was the highest she found in their study. 14% of electronic trading on the corporate bond market. Moreover, the price feeds that comes from dealer are only indicative. You cannot trade at those prices, and the beta spread are much wider than the stock, obviously. So my research questions are twofold. The first one is what is the effect of this liquid corporate bond ETF on the liquidity of their underlying bonds? There are two possible effects. The first one is that the ETF will increase the liquidity of the underlying bonds because of information efficiency. And you have the idea that the additional arbitrage opportunities, the multiple arbitrager competing for information, all facilitate price discovery and information increase the liquidity of the underlying securities. The opposite effect is an adverse selection effect where the ETF will decrease the bond liquidity because suddenly we have that in the Subramanian model where with the introduction of the basket, all the uninformed traders decide to trade the basket and all the informed traders are left trading the underlying securities. So the dealers on the underlying securities face more adverse selection, so they increase their transaction costs. And Thierry Foucault and co-author in their paper show that actually the arbitrage can be toxic and actually have negative effect on the underlying securities liquidity. And my second question is, does the dominate during periods of market stress? So maybe in normal time we have the effect one dominates, ETF have a positive effect, but maybe during periods of stress, it's actually the adverse selection dominating. So while doing this paper, it's an empirical paper, I investigate these things. I start with panel regression, then I turn to quasi-natural experiment to identify the causal impact of ETF. So I use recent data and recent experiments to try to investigate the impact of this ETF on their bonds, and moreover study periods of market stress and arbitrage. Just a quick preview of the result in case I don't have time to finish. I find that corporate bond ETF increased the liquidity of their underlying securities compared with bonds with ETF ownership stay stable. Bonds that exit ETF experience liquidity deterioration, while bonds that join ETF experience a liquidity improvement. And throughout my study and throughout my specification, I find that the results are robust to periods of market stress and arbitrage, both creation and redemptions. So the literature on the effect of ETF has been growing rapidly. Some of you have contributed to that literature. I just want to zoom in on the free paper in red here. So first, most of the literature has focused on equity ETF, and the paper closest to mine is Sagan-Tuzun and Firma's papers. They find that equity ETF increased the liquidity of their underlying securities, except during market stress events such as the crisis. All NEA focus on corporate bond ETF and also find that ETF increased the liquidity of their bonds. So I differ in 4 important ways. First, I use recent data, and it matters because, as I was showing in the first chart, the asset under management in bond ETF has only been growing in the last couple of years. Moreover, I try to improve the current identification by targeting directly the non-identification issues of self-selection and of self-selection of liquid securities by the ETF and of the index effects versus the ETF effect. Third, I focus on market stress events and arbitrage, and in both cases, I do not find that they interfere with my results. Now is the time to take the first question, if there are any.
So at the moment, there are no open questions. So if anybody has a question, please type them into the Q&As. And for now, we could proceed. Just one comment, sorry, on the technical front. It's sometimes, I think the Wi-Fi connection is not very good, but also there was a suggestion that if you have a phone, Thomas, next to you, if you remove it away from you, it might help with the buzzing that some of us have been hearing.
Oh, really? Okay.
Sorry. And then we can just go on. Thank
you. Shall I keep going?
Yeah, I think keep going, because for now there are no questions. So if any questions appear at the next break, then we'll stop to answer them.
Okay. So the data that I use is fairly classic. I use Trace to obtain corporate bond transactions. And I use these corporate bond transactions to create proxies of transaction cost. One important note compared to the version that Michael has of the paper and the one that you have is now I've updated the paper with data up to March 2020. So including the recent COVID event. The second important data set that I use is CRIS mutual fund holdings. I use it so I can obtain what are the holdings of ETF and of mutual funds. I try to be very extensive, include more transaction costs that I compute from the transaction on the bonds. I'll just show quickly the data, plot the data. So you can see this is Besson-Binder and Kumar Venkataram and Maxwell measure delta Q of corporate bond transaction cost over the decade. And you can see the large decrease throughout the last decade of corporate bond transaction cost. And the uptick that you see is the March 2020. 2,000 in basis points. So basically it went from 0.6% down to 0.25%. And the uptick was nearly 0.7% for March 2020 during the COVID data. My second important variable is the ETF ownership per bond. So these are the ETF holdings of a bond over the amount outstanding, what's available per bond. And this is in percent. And you can see the growth there. I know we have bonds that are on average held by 2% by ETF. So I'll start classically with parallel regression. I compute my transaction cost measure at the bond and month level. I take the median of the trading days. I add bond fixed effect, month fixed effect, and I regress the transaction cost on the lagged ETF ownership. I find a negative relation for a negative link for all my most of my proxies of transaction cost, meaning that ETF ownership is associated with bond liquidity. As I was saying, my second research question is what happened during periods of market stress. So, and this is how I relate to Saglam and to Zoom and Weimer's papers. So I rerun my parallel regression on a subsample with only the market stress periods. So I include the debt ceiling crisis that they use of around July 2011, the taper tantrum, the Trump election, and now the March 2020 data. And what I find is actually a stronger magnitude and still a positive link between ETF ownership and bond liquidity. And the results are fairly robust are quite robust to multiple robustness tests. So I investigate the impact of arbitrage by rerunning my parallel regression on periods of creation, redemptions, and normal month. And the results are robust to that. The results are robust if I split my panel in investment grade bonds or high yield bonds, liquid versus illiquid bonds, when I use only large trades. So my main result so far is that ETF ownership is associated with bond liquidity even during periods of market stress and even with arbitrage. But so far I cannot claim causality because ETF are known to self-select liquid securities. It's actually in the name of the largest corporate bond ETF. These are the liquid investment grade ETF. That's the name of LQD, for example. So to attempt to find the causal impact of ETF on their underlying bonds, I turn to quasi-natural experiment. So the first one that I used was identified by Datan and Davidenko. So in 2017, Bloomberg increased the minimum threshold to be part of an investment grade index. So they increased from 250 million to 300 million. As a result, bonds that were in that 250 to 300 million had to leave ETF and indices. So those are my treatment bonds. And my control bonds are bonds just above the threshold that stayed throughout the whole experiment. And then I run a difference and differences regression, classic. And the way that experiment deals with the self-selection is because at the beginning of the experiment, both my treatment bonds and my control bonds are in an ETF. So there's no, and then due to the index change, some bonds, my treatment bonds, exit the ETF. This is the result of my difference and differences. The post-treatment dummy is positive significant for most of my transaction cost measure, meaning that the bonds that left the ETF due to the index threshold increase experience an increase in their transaction cost. I run a placebo test where I advance the date of the announcement, and here the results are not significant, and there's no real relationship between my treatment and the transaction cost, showing that the event was plausibly exogenous. Importantly, I turn to the daily level and I investigate the impact of redemptions. And I interact my difference estimator with fire sale dummy on the days with large ETF redemptions. And the results still hold. My treatment bonds that left the ETF are more illiquid after they left the ETF, even when the ETF is being sold off and the bond within the ETF are necessarily sold off to proceed to the redemption. So far, the result of my natural experiment is that bonds that exit ETF experience a liquidity deterioration, and the results support the finding of my panel regression without the potential bias of ETF self-selecting liquid bonds, because both my treatment and my control bonds were in the ETF at the beginning of the experiment. And if you compare with earlier studies where the index or the ETF increased and selected new bonds, those bonds were self-selected by the ETF for their liquidity. So it's very hard to make the case that their increase in liquidity was due to the ETF effect and not to the ETF self-selection. Moreover, I find that even during ETF sell-off, the bond that stayed in ETF remained more liquid than the bonds that had left the ETF. Maybe I can stop now and take a question if there are.
So I don't believe that there are any open questions, at least if there are, then people are holding them to themselves. So maybe we'll proceed for now. And again, if there are any questions, please put them in the Q&A, or you can hold on to them and raise hand at the end, and then you'll get a chance to chat with Thomas about it. So Thomas, I'll return to you and we'll just continue.
Okay, I'll go to the second quasi-natural experiment. But so far I've shown that in all my regression, I used mutual fund ownership to control for the index effect. However, there are some doubts about the quality of that control variable. Maybe so far what I've seen was just an index effect and not an ETF effect. So to tackle that question directly, I've turned to a new quasi-natural experiment, again, very recent one that took place in 2018, quite similar to the previous one, but here the setup is different in the sense that the large ETF, so the fourth largest investment grade ETF in the US market, IGSB, change index. So what's really nice in this experiment is that indices do not change. They stay the same throughout my experiment, but the large ETF switch from tracking one to tracking the other. And what's interesting is that between the Bloomberg index with a bond with a time to maturity between 1 and 3 years, and the new index, the ICE Bank of America with a time maturity of the bond with a time to maturity of 1 to 5 years, bonds with a maturity between 3 and 5 years join the ETF after the ETF switch index. So there was a positive shock to the ETF ownership due to the ETF inclusion. This is how I select my treatment bonds, and for my control bonds, I reproduce what I did in my previous quasi-natural experiment. I use a propensity score matching following Danozer, and I make sure that their ETF ownership stays stable for the whole period. The nice thing about having experiments in 2018 is that my control bonds are in ETF. I compare both treatment bonds and control bonds, both are in ETF. The difference is my treatment bonds experience positive shock to their ETF ownership. Suddenly they're held much more by ETF. And so this is what I observed. They joined in August 2018, and after they joined, the transaction cost of my treatment bonds decreased. This is the same result in a panel setting, where you can see the difference in difference estimator is negative, meaning the bonds that join the ETF due to the index threshold change became less illiquid. The transaction cost decreased so that they became more liquid, in other words. So the result really confirmed that the ETF increased the liquidity of their corporate bonds. As I was saying, I'm interested in market stress events and arbitrage. So to investigate that claim, this time I have single ETF, so it's really easy for me to identify the days where the ETF experience arbitrage, and I measure arbitrage with creation redemptions. On that day, the ETF shares were they created, or were they redeemed, or did nothing happen? And actually, on those days, nothing happens to the ETF. So I reran my difference and differences on both panels of days with ETF arbitrage and days without ETF arbitrage. And I find the same negative relationship between the transaction cost and the post-treatment. So when you join ETF, you become more liquid, your transaction costs decrease, both on the days with ETF arbitrage than on the days without ETF arbitrage. And that's important because the one classic mechanism through which we thought that adverse selection effect will dominate was through the arbitrage with the underlying securities. So in conclusion of that second quasi-natural experiment, I find that bonds that join ETF experience a liquidity improvement. And this identification supports the finding of my previous test without the index effects, because this time indices they stayed the same. It's only the ETF that switch from replicating one index to the other. And moreover, I show that results are robust to arbitrage and its absence. And we know that arbitrage is linked to period of volatility, because when there are volatility and stress in the market, that's what put prices out of line and make arbitrage profitable. Maybe I can stop here. I think I saw the question.
Yes, actually. So there are two questions. The first, I'll start through them in the order they came in. So the first one was from Marco Rossi, and it came right after the first quasi-natural experiment, but right before my screen delayed displaying it. So it's actually, I think, refers to your first experiment. Its question is, not all bonds that are ineligible are subsequently sold. What if ETFs just get rid of illiquid bonds?
So is it, yeah, it's related to the first one. So did they get rid of just the illiquid one? So I investigate that claim that that the portfolio manager actually chose which bond to keep and which bonds not to keep. in the internet appendix, because it's true that some portfolio manager, ETF portfolio manager, kept the bonds even though they were no longer in the indices. So in my main specification, which I showed, there are no longer, I don't include them as treatment bonds if they didn't exit ETF entirely. But in the internet appendix, I rerun my experiments by adding all the bonds that should have been excluded, whether they were excluded or not. All the bonds that that are in that threshold, 250 million to 300 million, all the bonds that should have been excluded, I consider them as treatment bonds. So that is to say illiquid and liquid bonds. And the results are robust to this test as well. I have similar results on that alternative specification of the quasi-natural experiment.
So the next question came from Emmy Edwards, and so she says, I like that you look for exogenous shocks. For the second one, the tracking index change, do you know why the ETF changed its tracking index? Was it liquidity related?
That's a very good question as well. So it's actually a question valuable for both experiments. So on the first experiment, Bloomberg increased its threshold. It had increased its threshold in the past, 20 years before. So it's something that comes infrequently, but that does happen. On the second experiment, iShares contract was coming to an end with Bloomberg, and they switched index provider as it was because the contract was coming to an end. And the way I interpret it is that it was the way they picked a different bonds with a different maturity on the new index. I interpret it as a competitive move against Vanguard that has a successful ETF just with larger assets under management than this iShares one. The Vanguard 5 years bond. So the contract was coming to an end with Bloomberg. iShares probably wanted to compete with Vanguard's ETF, and that's why they switched to that index. So it seemed to be more a strategic move and not plausibly not directly linked to the liquidity of the underlying bonds. Moreover, I run a placebo test as well, showing that if it was not exogenous, that placebo test would necessarily fail. Especially since I use 8 proxies of transaction costs, so I would expect to have a few of them turning on there. But thank you for the question.
And then finally, we have a comment, not a question. I'll read it, and then I let you see if you think that you'd like to respond now, or if it's a comment. Just a quick comment from Mehmet Saglam. Just a quick clarification about our finding in Saglam Tuzun Varmas during stressful times. We condition on the sign of the trade, and we find that only sell trades are costlier for stocks with high ETF ownership in stressful periods.
Thank you, and sorry if I mispresented your work. So yes, and maybe the way I can comment. So why is my result different from their result? I think it's what I agree in the paper is that we're talking about 2 different subjects: equity ETF with quite liquid underlying securities, and here I'm talking about bond ETF, as I was saying in the introduction, with quite illiquid underlying securities with large transaction costs. And the large transaction costs on the bonds make the arbitrage quite costly. Trading the ETF against the bonds mean crossing the beta spread on the bonds, which is, as I was saying, it costs 0.03%, between 0.3 and 0.6% to cross that beta spread. So you don't do it very often, and you certainly don't do it in the magnitude and the frequency that you will do on an equity ETF with quite liquid underlying securities compared to bonds. But your point is very well taken.
So I'll ask one more question that came through the chat rather than Q&A, and so I didn't see it right away. And this would be the last question, and afterwards we'll move to the conclusion, and then we'll move to Michael. So the question is from Davidson Heath. If ETF are challenging uninformed orders into index bonds, it makes sense their liquidity will improve. But what are the effects on non-index bonds? Are there negative effects? And relatedly, is there an effect on the incentive for informed trading in non-index bonds? What happens to price informativeness?
It's quite a topic. Very, very interesting questions. Unfortunately, I don't have a lot to say about non-index bonds because I don't look at them specifically. I can definitely take a look at them. The issue is that the non-index bond tends to be not very liquid. They tend not to trade, so I don't have data on them. I don't have transaction on them, so I cannot compute transaction cost data on most of them. So this is very difficult to answer that question for non-index bonds. I could see if they traded more after, but this is not something I'm currently doing, so I can't answer that question. And what happens to price informativeness? Again, that's a very good question, but this is not my research question. I don't look at it directly. It's been studied on equity ETF. It's quite Madavan and Subsec find that that the price discovery tends to be on the ETF, and that's the mechanism through which that would explain my result, being that the ETF provides price discovery and price informativeness, and that translates into lower transaction cost on the bonds. But thank you for your question. Maybe I should have a look at non-index bonds. Thank you. And I'll conclude briefly. So what I showed in this paper is what I did is I used panel data and recent quasi-natural experiments to address the identification issue of the self-selection and of the index effect to find the true effect of corporate bond ETF on their underlying securities and a causal effect of the ETF. And I find a positive causal relationship between fixed income ETF ownership and the liquidity of the underlying bonds. However, I try to focus on periods of market stress with ETF sell-off, with redemptions, and I've shown that the results seem robust for the corporate bond ETF that I studied, that the positive relationship is still there between ETF and their underlying bonds liquidity, even during periods of market stress, even with ETF sell-off. And I do not find that ETF arbitrage is the transmission mechanism through which the bond becomes more liquid, because the bonds are more liquid every day, on the day with ETF arbitrage and on the day without ETF arbitrage. Thank you very much for your question, and I'll let Michael discuss the paper. Thank you.
Thank you very much, Thomas. Our discussant is Michael Goldstein. Michael, the floor is all yours.
Thank you very much. That was an excellent presentation by Thomas. I'm going to try to get my slides up. Hopefully it will work. An example of transaction costs. Before I start, though, I want to thank Katja, Andreas, and the organizers for putting together for such a long time such an amazingly wonderful conference. Of course, also to Thomas for really doing such a great job in his presentation. One of the benefits of being a discussant is you realize no one came to hear you. So what discussions sometimes tend to do is put a paper in context and to maybe give a flavor of the paper to people who haven't read it. It's not a referee report, it's just kind of a discussion, and that's what we'll hope to do. All right, let's see if I can get this to move down, which is my biggest problem. There we go. Okay. I want to highlight, this is actually the third or fourth in a series of papers on bonds for the Microstructure.Exchange. We had a variety of excellent ones on ETF liquidity. And then in the past 2 weeks, we've had both corporate bond price reversals and then this very wonderful paper also by Thomas Ernst on stock-specific price discovery from ETFs. For those of you that attended both of those, and this is the third in that series or the fourth in that series, depending whether you're starting just with the summer portion or not, I want to point out for people who were here for last week and the week before that there were 2 excellent discussions by my colleague Edie Hotchkiss and Thierry Foucault, and everybody should immediately, Bayesian prior, lower their expectations because this will not nearly live up to those. Okay. For those of you old enough to remember, I periodically have written microstructure in both bonds and in stocks and equities. And so I'd like to highlight and grab some from last week's presentation that the time periods for execution in these 2 areas are quite different. In fact, last week we were worried about microseconds. And this week we are not worried about microseconds. The bonds are not like equities. Bonds are very illiquid. Last week, 2 weeks ago, I think we did see something that pointed out like look, this is going to trade, and then the next day something else is going to happen. There's about a median of 3.1 trades per month in bonds, so more than half the months have no trades at all, it turns out. And very active bonds, even if you take very active bonds, they trade not an awful lot, about 12 trades a month, which causes in research the focus mostly on liquid bonds. Generally, there's no 2 pre-trade double-sided firm hittable quotes as there are in equities. So again, that actually makes the calculations of traditional liquidity measures such as the effective spread, which I've used a lot and help create, difficult. And so that just as a reminder, sometimes the traditional equity measures, techniques, and intuition might not be appropriate for corporate bond liquidity studies. And in fact, even when we try to use corporate bond liquidity studies, we run into this problem of finding days with multiple trades, say for the Amahud measure, the imputed round trip cost measure, which kind of require multiple trades per day, which we just saw is relatively unlikely. Other ones, the Korn-Schultz measure and the roll measure, and even the bid-ask measure, you might argue, also kind of came out of the equity world. And while they're used in this paper and used in other papers, and people use them in bonds, I just again want to highlight, their origins come from a very different world where there's thousands of trades and pre-trade, liquidity and a lot of assumptions. Particularly if you think about the roll measure, the idea that you're bouncing from bid to ask is maybe true in the equity world. I'm not totally sure that that's true in the bond world. Then just a quick note about the Amahud measure. It implicitly assumes volume made price move, not that information changed quotes. For illiquid bonds, that's less likely to be true just because there's a long time between transactions, and so it very well could be that some information came in. I might want to slightly argue that corporate bonds are priced somewhat like a derivative in the sense that they're priced off of other things, especially if you're illiquid, priced off of treasuries, priced off of each other. There's matrix pricing. And so the danger again with an Amahud measure or other measures is, particularly Amahud measures, there might not have been a lot of trading, but there was movement in other bonds, and that caused the change in the returns that we see. And so just remember, it's imagine this was a stock and equity thing, but you only saw the S&P 500 SPY, for example, trade twice a day. Meanwhile, the S&P 500 futures are trading, in microseconds. We would misinterpret the Amahud measure as something moving on very little volume when it really was just tied to the S&P 500 futures. futures. And then a little bit about bonds. Generally, if you want to trade more in equities, you get higher spreads and things. But just to remember, actually the spreads are smaller, at least per bond, not in absolute dollar value, when you trade larger amounts, so that actually a small retail buy will have a lower price than a large buy, and you might measure that incorrectly. It's just the difference in the magnitude. If you just had a small buy by retail trade and then a large buy later in the day, you might measure that incorrectly as a big price change, when in fact it's really just no price change, but just the difference in the nature of the spreads. And especially because it was a small buy initially, you might interpret that as low volume. So we could do this vice versa. It doesn't matter either way. So getting to this paper links. I just want to say, like, first off, the results are believable. Like one of the nice things when you read a paper is, like, at the end, do you think it's correct? Like, yes, I think it's basically correct. There are many liquidity variables considered. There's a beautiful quasi-natural experiments in both directions. I really like the placebo effects test. That part I don't think you spoke about in the presentation, but it's very useful, and it's a very important area. Um, You've seen this graph. This graph kind of explains a lot of the nature of the test, which is, look, something happened, the controls didn't really move, the treatments moved. This is in the quasi pair number 2. I wasn't sure, Thomas, you were going to show it, so I wanted to make sure people saw it because I thought it was great. All right, there's some conceptual issues. I think it was alluded to in one of the questions about uninformed trading, and couldn't it be possible? And if you think about if there was informed trading only with knowledge of some of the bonds, but you're trading a basket, that might cause actually technically uninformed flow in the other bonds as part of that basket as the whole basket's traded, which could create some noise trading. And so that might make spreads decrease. It's just something to think about in the writing area. The limit arbitrage, there's a comment about it being due to big spreads, and I agree in absolute dollars. I didn't know, and maybe just as an order of magnitude, you could give me a feel for whether the magnitude and spreads are between the SP equities and futures. Futures have very low spreads. Whether that's the same order of magnitude we're talking about, that might be helpful. But clearly the trade frequency is much different. I would argue that's the real problem for arbitrage, which is you don't even know if you can get the trade, which is not a worry in an SP 500 stock, generally speaking. And then a nice aspect about this paper, it talks about mutual funds. Of course, they have daily inflows and outflows that affect liquidity as well. So that's a nice aspect of this paper. A little now for the flavor for other readers. It is similar in structure to Danhauser, the JFE paper, which also looks at corporate bonds and looks at 2 novel quasi-natural experiments like this paper does, but does not necessarily test the liquidity control variable, and finds certain results that are not, I don't believe, are quite the same as in this paper. And actually, I think that should be highlighted more in the paper. It was not as clear. To highlight this, though, a little bit more, the equation ones both seem awfully similar to me with just the opposite sides. You might actually make that point. It implies, though, I mean, look, regressions, we always have to remember, are a correlation, not causality. But it does bring up the interesting question, that technically something called the independent variable and something called the dependent variable. And what I would say is the literature is not convinced which one is which right now if you look at these 2 papers. And that's worth talking about in the paper, I think, a little bit more, and it's to give people a feel for how this paper might fit in with Danhauser. Again, similar, the table 10 was very similar, but not at all the same control variables. This is actually from Danhauser, and it's again to give you a feel that, that Danhauser also looks at a lot of these variables. It's not a complaint, it's just more of a, yeah, but if you check Thomas's paper, it actually looks at different things in a slightly different way. One of the things that did strike me, I'm getting near the end, one of the things that did strike me is that the R-squareds are kind of low. In fact, they're as low as 0.001 or 0.1%, I think, despite lots of observations still. Sometimes we have R-squareds of only 1%. So somewhere deep in the paper, I think the internet appendix is some comment of like, we don't find statistical significance, but we don't have a lot of observations, and I might caution against that. I think to a corporate person, you have a lot of observations. Strong points, great placebo tests. I know this is unusual. Normally we say we complain about the writing. I want to give a special call out to the writing. In the internet appendix, there is a great description of the ETF primary market that I think everybody should. I mean, I read that and I thought that was just perfect. And this one sentence in bold, which I won't read for you because you can read, is really a tremendous sentence that made everything very clear about how things work. And we always complain, I mean, say we frequently complain about writing when we write referee reports. Time to call out some good writing. So I thought that was great. Kind of closing up, some statistical suggestions, which wouldn't mean to anything except for to you, is probably you have a couple times you segment things out. I really like the segmenting out, but you might get more power if you kind of throw them all into one and dummied the high and the low ends. Some of the tables where you're doing kind of an overview would be helpful if you threw in some difference of differences tests. I would argue strongly that trading during birth and death of bonds are different. Birth, we've shown really has unusually high trading. And honestly, if a bond's about to mature in 2-3 months, why bother trading it to begin with? So you might avoid those in your tests. The propensity score, this is just an intellectually question that used propensity score, though you required the FAMA French 12 sector to be absolutely the same. And that got me thinking like, oh, I'm not sure I think of all those things that are in the propensity scores equally weighted as importance. So I might, maturity bucket and rating bucket things too and say they've got to at least be within those. Um, I really didn't know, I know that actual ETFs don't hold every single bond that's in the indice, but we could talk a little bit more about that, be helpful. I will say that I didn't view the natural experiment number 2 as having overwhelmingly strong results, especially if we pop up the numbers, you can kind of see that, but that's okay. But just to kind of caution there, that was not nearly it wasn't that strong and we should be careful. I'm always concerned about rating numbers. The people who've dealt with me know this, that, things aren't really linear. It's not really true. It's a step up in that it's equal across all ratings, and regressions and principal components will tend to treat it more like it's linear. So maybe bucketing, that's a place that bucketing I think might be very helpful, especially in high yield and investment grade. And then generally comparing and contrasting your results with Danhauser's, which I think are different, would actually be a really nice contribution. So in summary, and I promised I would stay within time, which is unusual for me because I normally don't stay within time. It's very believable results, follows very closely, has extremely low R squares with beautiful placebo tests. And just for those that you might read it, it is beautifully written, but long. The internet appendix is longer than the actual paper itself at 48 pages, but I thought it was an important aspect and to read. And so just for those of you that are going to download it and read it, just be aware that the internet appendix has a lot of stuff in it, and there's a lot of tables in this paper. So thank you very much. That was excellent.
Thank you very much, Michael. Oh, you just stopped sharing. There was a request for you whether you could show again the great sentence from the appendix.
Absolutely.
And the
Sorry, can you
question
still
was
hear?
upvoted. Yes, we can still hear you.
Okay, I apologize. No one's ever said I'm pithy, so I didn't want to. I didn't want to abuse my time too much. But I really like this sentence about the ETF. So what it is, the first bullet point, then goes the second in the internet appendix. It reads the ETF primary market resolves two opposed objectives, and then it says it assures that the ETF is priced fairly with regard to the underlying securities. Actually, I can't see all of it because the pictures of you guys are in the way. Hang on. During the trading day, while being an open-ended fund that lets in and lets go investors that decide to do so. It was a great description of how an ETF is kind of like being an open-ended fund and not being an open-ended fund, in the sense that, as the next sentence said, thus the fund number of shares can evolve daily according to supply and demand. What I really also picked up from that, look, it's time to tell people when they did a great job. And I want to say, like, I really got from that, look, there's trading during the day, but like an open-ended fund, the total number, that's kind of when the resumptions happen. Basically, at the end of the day, it's basically once a day that the total number of fund shares seem to change, and it has somehow bridged. It's like an open, it's closer to being an open-ended fund that way than I had previously thought. Sorry to go on. I really liked, look, everyone could tell, I really liked that section of the internet appendix, and I think people should read it and cite it.
Okay, thank you very much again. Really appreciate your comments, and I'm sure so does Thomas. Now, we're following the NBR rules, so you can't respond to Michael directly. Of course, you're welcome to respond to him later, or if somebody asks his comment as a question. And that said, we're moving on to questions. And the first question is from Tukan. And I apologize, I'm probably mispronouncing your name horribly.
Can you guys hear me?
Yes.
Okay, great. So thanks so much. So this is a great topic and great paper, Thomas. So in addressing this question, I think there are several layers of difficulty. So one of them, I think you are doing a pretty good job in terms of trying to find the good identification. But if you go into the bond ETF, space, actually for all ETFs, like, if you are trying to figure out the channels of liquidity improvement, then it gets even harder because, trying to identify the right arbitrage activity, because like the primary market activity may not be completely the only arbitrage. A lot of the traders actually do it during the day or within a couple of days, and then they offset their position without going to the primary market. And actually, if you go into, this is true for all the ETFs. If you go into the bond ETFs, actually there's another layer of difficulty, which is the differences between creation, redemption, and holding baskets. So if you look at those baskets differently, differences in those baskets, you will see that creation and redemption baskets are actually the most liquid bonds that ETFs actually own. But the holdings basket actually is much bigger, and it includes like already illiquid baskets. So like, when you look at the arbitrage mechanism, I guess, you are already conditioning a couple of times whether they are already liquid or not.
Thank you. Thank you for the question. Full disclosure, I was an ETF market maker on the bond before I did my PhD at Dauphine. So I did the arbitrage and I did trade this creation redemption basket for 3 years. And I would agree that it would be interesting to, I don't have the data, the daily data on these baskets every day, but my experience is they tend to be so the bond ETF, if you think of the large one as nearly 2,000 bonds or at least 1,000 bonds, and the basket will have 50 to 100 bonds within it. And it's true that there'll be, for the most part, liquid securities in it, but there'll be a couple of illiquid securities within the basket. And it's actually a matter if you can find those illiquid bonds that will really make the creation or the redemption cheaper or interesting. So it's a tricky question. And if you think about identification, then what bonds can you compare those bonds in baskets with? Can you compare those bonds with? Because you need to find an illiquid bonds that trades that day. It's quite difficult, as you said, as identification. But thank you for your question.
Thank you.
So I should mention that the raise hand function is enabled. So if you'd like to ask a question live, please raise your hand so that I may enable you to speak. In the meantime, the next question is also, there was a question from Q&A from Liu. Again, I'm sorry, I'm mispronouncing your name. Go ahead.
Yeah, can you hear me?
Yes.
Yeah, so I noticed that your sample period obviously stopped before then, but I'm just wondering if you had any thoughts on sort of the actions of the Fed recently in terms of the announcement that they would buy bond ETFs in April, and then sort of the lag associated with that in terms of when they actually started purchasing bonds, I think in May, but it didn't really pick up until June, and sort of how that would square with the results from essentially the earlier part of the decade that you had.
So you're right. It's a very interesting development. What happened with the Fed buying those corporate bonds that I'm studying in this paper. So my understanding is that the Fed announced in March, I think the 20th or the 23rd of March, that they will buy ETF. And following that announcement, there was a very large creation of corporate bond, meaning that people were buying the corporate bond ETF, buying so much that ETF market makers had to create ETF shares and buy the underlying bonds. So the effect looked very large. If in some of my tests we run on month with large creation and large redemption, and actually February is a month with some of the largest redemption, and March is one of the months with the largest creation, even though the beginning of March was very negative. In April, I don't have much data, but well, what I wanted to show is what I'm not sure what the real effect of the Fed buying the bond is, but the announcement was enough, as far as I can tell from the data. Even before they actually started buying, everybody in the market was buying those corporate bond ETF.
Okay, so thank you very much. Well, so the time is noon. So at this point, the formal part of the seminar is over. So I just want to thank everyone for attending, and we'll hope to see you next week again. And Tawa and Michael, I have agreed to stay for a few minutes longer. So if you still have questions, please use the raise hand function so that I may enable you to speak. See you all next week. Or if you have questions for Michael. I don't see any raise hand functions, but we'll just hang here as people are logging out. And informally, you probably can respond to Michael now that the formal part of the seminar is over, if you wanted to respond to Michael.
Gotcha. That's very dangerous.
I know. Thank you.
I shouldn't. Maybe I should wait until the count goes to zero. Yeah. Should I?
Thomas responding to me is fine. I thought you were opening up the whole world to just respond to me on anything. I was thinking, like, uh-oh. That'll be a free for all.
No. Okay, so I don't see any more raised hands, so I think that there is still a question in Q&A that did not come. Oh no, that's just a thank you to you. So I'll see you next week, hopefully. Thanks again. Thanks to Marta. Thanks to Michael for a discussion.
Thank you. It's great to see you. Congratulations again, Thomas.
Good to see you.
Thank you very much.